All right, section 3.6, free cash flow to firm and FCFE on a uses of free cash flow basis. Hopefully you have realized this, but in all these earlier sections, we have calculated FCFF and FCFE from various income or cash flow starting points. Example, net income or cash flow. So we started with net income, or we started with CFO, and then we made adjustments to come up with FCFF and FCFE. This is the classic way of coming up with your FCFF and FCFE. An alternative perspective examines the uses of free cash flow. And can you think about what the uses of free cash flow might be? What happens with free cash flow to equity, for example? This is used to pay out dividends, or this could be used to repurchase shares. This could be used to maybe acquire other companies and so on. So you can evaluate the various uses and then add up those numbers to come up with an estimate of FCFE. But I'm not going to spend much time on this for two reasons. This particular section doesn't really have any examples, and it is not explicitly emphasized in the learning objectives. So if you really want, you can read through this section carefully, but I don't think it's overly important. Okay, section 3.7 now, forecasting FCFF and FCFE. This is largely straightforward, just a few subtleties that might confuse you, and I'll cover those in detail. One way of forecasting FCFF or FCFE is a simple constant growth assumption. So you can come up with your FCFF over the upcoming year and then assume that this will grow at a constant rate of 5%. And where do you come up with this number? The simplest thing to do is to use some historical growth rate. Not some historical growth rate, but the historical growth rate of this particular company. And if you have reason to believe that this rate will continue, then you use it. Example 8 is one of the simplest examples you'll ever find which uses this method. Then here is something that is relatively new. Almost everything you've heard so far probably should look familiar. But another way of forecasting free cash flow is to forecast components separately. So you forecast sales growth, you forecast operating margins, and then based on that you can forecast operating profits. You also estimate fixed capital investment and working capital investment generally as a percentage of sales. To come up with FCFE, you will also have to estimate net borrowing, and you do that based on your estimate of these investments plus your estimate of a debt ratio. A debt ratio means that for every 100 that you need, if your debt ratio is 40%, that means that for a planned investment of 100, your borrowing is going to be 40. So in all the examples that are based on this material, the debt ratio will be given to you. And the debt ratio essentially comes from the planned capital structure of the company. So in the examples that we'll work on, we'll make some key or some important assumptions. The first is that investments in fixed assets and working capital bear a constant relationship to increase in sales. So if the sales are increasing by 30%, then that increase in sales has a direct relationship with the investment in additional fixed capital or working capital. Also, unless we are told otherwise, we assume that the capital structure or the debt ratio remains constant. So let us look at this particular example now, example 9, and I want you to read this before I explain the content. This is material that you have not explicitly seen before. So let me walk you through this. So for this particular company, we are told that in 2007, the sales are 3,000 million, and we are expecting a 10% increase. So the expected sales for 2008 are 3,300 million. We are also told that we expect the EBIT margin to be 16.67%. So that means that we can calculate EBIT for 2008 based on this number. Then we also know the tax rate so we can multiply EBIT by 1 minus T. That is easy. But the two main items that you are learning through this example are, number one, how to deal with the investment in fixed capital and how to deal with the investment in working capital. Let's start with fixed capital. We've already said that the investment in fixed capital is tied to the increase in sales. We are also given this information. The amount for purchases of fixed assets was 400 million and the depreciation was 300 million. So the incremental expense on fixed capital is 100. And now you are looking at this as a percentage of sales. So note that sales went up by 300. So what we are saying is that if sales go up by 300, then our working capital is increasing by 100. In other words, this 33.33% is saying that for every dollar of additional sales, the investment in fixed capital is 0.33. Incremental working capital investment in the past year was 45, and this was given earlier. And that is saying then that for every dollar increase in sales, the amount of incremental money spent on working capital is 0.15. So putting all this together, for 2008 then we are saying that if sales go up to 3,300, EBIT is 16.67%, which is given. EBIT into 1 minus tax rate is 330, again based on the tax rate. And then incremental fixed capital is 100. Why 100? Because it is going to be 33.33% of the increase in sales. And working capital, you subtract 45, 15% of increase in sales. So this is your free cash flow. And if you make an assumption that these ratios and numbers will continue in the future, then based on the sales projection, you can then also project your free cash flow. Or if you assume that this company will have tighter margins, if you believe that the EBIT margin will shrink, then you can make that assumption. If you believe that these ratios are going to change, then you can make those assumptions. But generally, we assume in most of the examples here that the ratio to sales of fixed capital investment and working capital investment generally stays the same. Okay, example 10 is related. This connects with what I was just saying. Our analyst now believes that the margins will come down and we don't need to work through all these numbers, but notice here that EBIT margins are coming down, but what's happening to incremental fixed capital investments? They are still staying at 33% and 15% of the sales growth. So you can then come up with your free cash flow to firm estimates. Okay, example 11 covers another important point, which has to do with figuring out your net borrowing. And I want you to pay close attention because this is not something you've seen before. So now our analyst wants to evaluate FCFE. And to come up with FCFE, if you are starting out with FCFF, you also need to figure out what the net borrowing amount must be. If we assume a 50% debt ratio, what does this mean? This means that for every $100 of additional investment, how much will we have to borrow? We'll have to, the debt or the borrowing will have to be 50. So we need to come up with our investment amount. And what is that investment amount? We have already established that the investment in fixed capital is 100. The investment in working capital is 45. So what is the total investment required? 145. So what is the net borrowing? 72.50. Where is this coming from? This is simply 50% of our total investment. And then where is this FCFE number coming from? So what we are doing is we are starting with 264 and then deducting the incremental fixed capital investment, deducting the working capital investment, adding the net borrowing, and that gives us 191.50. Okay, coming to the last segment of section 3, other issues in free cash flow analysis. Analysts should adjust the reported CFO number by removing the impact of financing or investing activities. The curriculum refers to these as contaminations. You are starting out with a CFO number which has been created based on US GAAP or IFRS, so that is the reported number. But if you are coming up with a CFO in order to do valuation, then you need to remove any impact of financing or investing that might have crept into the reported number. So remove those contaminations and then you have a clean CFO number. Use that as a basis for your valuation. Here is a point that we've talked about before, but it needs to be emphasized. Many analysts prefer FCFF valuation models over dividend discount models for these reasons. Several companies pay little or no dividends. With some companies, dividend payments are at the discretion. In fact, in general, dividend payments are at the discretion of the corporation's board of directors and might not be indicative of the company's long-term profitability. So a company might be very profitable but might be paying very little dividends. FCFE is the cash flow available to shareholders without impairing company's value. What does this mean? When we come up with FCFE, we are subtracting the necessary investments in working capital and fixed capital. So this number that we come up with is based on the assumption that the company will keep investing in assets and projects that it should be investing in. Now, in all the formulas that we've talked about so far, dividends and share repurchases and so on are not visible at all. Why is that? The reason is that if you take FCFE, the dividends and share repurchases are happening from the FCFE. So these activities happen after you come up with FCFE, or you can think of this is the pool of money. Then money can be given out to shareholders as dividends or as share repurchases. So these happen afterwards. That's why in calculating the FCFE, we do not add or subtract any of the transactions with shareholders. So there is a question about issuance. The point with issuance is that issuance is a financing activity. So this is where shareholders are putting more money into the company. Whereas when we talk about FCFE, we are talking about the money that is being generated by the company, which is available for equity holders or shareholders. Continuing with measures of cash flow, FCFF and FCFE, as defined in this reading, are measures of cash flow designed for valuation of the firm or its equity. Other definitions of free cash flow frequently appear in textbooks, articles, and vendor-supplied databases of financial information or public companies. This text, by the way, is straight from the curriculum. Because using free cash flow analysis requires considerable care and understanding, some practitioners erroneously use earnings components such as net income, EBIT, EBITDA, or CFO in a discounted cash flow valuation. Such mistakes may lead the practitioner to systematically overstate or understate value. Before I go on to this next point, which is fairly testable, I just want to emphasize this exact point. I have seen students come to me who complain that the definition of free cash flow in another textbook is different. And that exactly is the point being made over here, that in different places you will find different definitions. And you as an analyst need to understand the definition and understand the context behind that definition. The context here is that if you are valuing a company, then the definitions used here are most appropriate. And whether or not you agree with it, if you are taking the CFA exam, then just agree with the fact that these definitions are most appropriate from a valuation perspective. One of the most commonly used proxies or shortcuts for free cash flow is EBITDA. And perhaps the reason for this happening is that you can quickly look at an income statement of a company and extract EBITDA. You don't need to do all these complicated calculations related to working capital investment, fixed capital investment, net borrowing, and so on. So an exam question might involve figuring out what are the limitations of EBITDA as a proxy of free cash flow. And the quick way of coming up with the issues is by simply looking at this formula. This formula shows the relationship between FCFF and EBITDA. So if you are saying that EBITDA is a proxy or an approximation of FCFF, what are the areas that you are missing? So note that EBITDA does not subtract taxes. When you think of FCFF, is that money before taxes or after taxes? It's after taxes, because the shareholders and the bondholders get money after taxes. So EBITDA does not subtract taxes. That's one issue. The other issue is that EBITDA does not tell you about this depreciation tax shield. Do shareholders and bondholders, so does the firm benefit because of the depreciation tax shield? Yes. That is not accounted for in the EBITDA measure. It is accounted for in FCFF. Fixed capital investments, does that reduce the cash available to the suppliers of capital? Yes. Not accounted for in EBITDA. Working capital investment also not accounted for in EBITDA. So just looking at this, issue number 1, taxes; issue number 2, depreciation tax shield; issue number 3, fixed capital investment not accounted for; and issue number 4, working capital investment not accounted for. So you need to reel these out based on the formula. So here is a classic example that I can easily see showing up on the exam, or something like this. A recent job applicant made some interesting comments about FCFE and FCFF. So this is what he said. I don't like the definitions of FCFE and FCFF because they are unnecessarily complicated and confusing. And I can see some people saying that. The best measure of FCFE, the funds available to pay dividends, is simply net income. You take the net income number straight from the income statement and don't need to make any further adjustments. So remember, this is the interviewee saying all this. Similarly, the best measure of FCFF, the funds available to the company's suppliers of capital, is EBITDA. You can take EBITDA straight from the income statement and you don't need to consider using anything else. How would you respond to the job applicant's definition of FCFE and FCFF? Personally, what I do is ask him to leave and sign up for the CFA program. But obviously that's not what this question is looking for. So what do we do? It's fairly straightforward. So what did he say about net income? So instead of FCFE, he's saying that just take net income. So to look at the problem with that statement, you go to this formula which shows the link between FCFE and net income. So if you do net income, you are ignoring non-cash charges, you are ignoring the investments in fixed capital and working capital, and you are ignoring net borrowing. If you use EBITDA as a proxy for FCFF, then we've already talked about the limitations of that measure. All right. So we are getting to the end of this segment. How do you deal with preferred stock? Everything that we've talked about so far basically says debt and equity. But what if you have a somewhat complex capital structure that involves preferred stock? That is illustrated in example 13. Now you can go through this, but what I'll do is just highlight the fundamental point. In this particular example, you are first asked to calculate WACC, which is extremely straightforward. You've seen this at level 1 in cost of capital and then again at level 2. So you can take the weighted average cost of capital based on the information provided. Then this is actually the part that is important. If the company did not issue preferred stock, then FCFF would be essentially the relationship that we've been talking about. If preferred stock had been paid and net income is income available to common shareholders, which is what has been defined over here, the preferred dividends must be added back just as the after-tax interest expenses are. Does this make sense? That just like you add back after-tax interest expense because you are identifying the money available also to debt holders, now you need to add back preferred dividend because the preferred shareholders are also suppliers of capital. But will that be on an after-tax basis or not? In the case of preferred dividend, there is no tax deduction. So all you do is add back the preferred dividend also. In this particular example, the preferred dividends are 8. So in our expression, we are adding back 8. So that is the major item being emphasized in this example. Other than that, the material is similar to what we've seen in other places. So you can go through the solution. You come up with FCFF at the end of period 1 and then use Gordon growth to come up with the value of the firm. Then you come up with the value of the equity by taking firm value and subtracting the market value of debt and the market value of preferred shares. We now come to section 4, which is much shorter than section 3, free cash flow model variations. And here we have 4 subsections. The first one is an international application of the single stage model. Then we talk about sensitivity analysis, and then the 2-stage and 3-stage growth models. Fortunately for us, a lot of what we'll see here is an overlap with what we've seen before. And this is a larger point with equity, that there is a substantial amount of overlap. So I think that you really need to do well on this particular topic. Okay, so 4.1, international application of a single stage model. Now, when this particular reading talks about international, it is actually specifically talking about countries where there is relatively high inflation. So if I were naming this section, I would really refer to it as emerging markets. When you are investing in stocks in high inflation countries, then typically you will use real cash flows and then real interest rates to discount numbers. Okay, because with inflation, if the numbers are high, they might be hard to predict in nominal terms. So you bring everything to real terms. And as we've seen in corporate finance, if you are projecting your cash flow in real terms, then you should also discount using a real rate as opposed to a nominal rate. So how do you come up with a real discount rate? There are different ways of doing this, but the method that is given in this particular reading is essentially a build-up model, which we studied in an earlier reading. So let's say you are trying to come up with the appropriate discount rate for company X, which is in an emerging market country with relatively high inflation. The first thing you do is use the real rate that is perhaps the average rate for that particular country, so the country real rate, and then you make a few adjustments. One adjustment is related to the industry, and these numbers might be plus or minus. We don't need to get too hung up with this because, as you will see in an example which will follow on the next slide, the numbers will be given to you. All you really need to know is that there'll be adjustments. There'll be a size-related adjustment, leverage-related adjustment, and then you will come up with the required real rate to use. Then you simply use your Gordon growth model, where you take the real growth and discount using R minus G, all real numbers. Okay, so here is a very straightforward example. It might look complicated, but the underlying concept is straightforward. You are given the various adjustments in this discussion over here. This is the country real rate, and then these various adjustments are given, and you come up with the required rate. Then your value is FCFE into 1 plus G, so that's this over R minus G, and you come up with a number. So nothing too complicated. Next is sensitivity analysis of FCFF and FCFE valuations, and this is something you've also seen before. To examine how sensitive the final valuation is to changes in each of the valuation model's input variables, analysts can perform a sensitivity analysis. Some input variables have a much larger impact on stock valuation than others, and this is illustrated in example 15. I'm not reproducing all of example 15, just exhibit 14, which demonstrates that with each variable, when you use a base case, low level estimate, high estimate, between the low and high, you will get different valuations. And you can look at the numbers to see that even small changes in the growth rate can have quite a substantial impact on the value that you calculate. And again, this should be nothing new. We've seen this before. Continuing with material that we've seen before, two-stage free cash flow models. We talked about this in the context of dividend discount models. Now, instead of taking dividends, we take free cash flows, and then after that the concept is the same. So this formula is one that you should be quite familiar with by now. What do you do in a two-stage model? You basically say that in stage one, you have a relatively high growth rate, and if you don't know the precise growth rate, you might actually say that initially growing at 20%, then 15%, but for a certain period, you take all the free cash flows based on whatever growth rate, and then after a given point, you then either assume a sustainable constant growth rate, or what you might do is just take a terminal value and a multiple and come up with, basically take a multiple, come up with the terminal value and discount back. Exactly like what we have seen before. A very simple scenario is given in example 16, where we are told that for 3 years the growth rate is 20% and then it is 6% forever. And the assumption here is that we can then compute the free cash flow per share, and you discount back each of these cash flows, and then for all these other cash flows you assume the Gordon growth model and discount back. Since you've done this before, I'm not going to repeat the calculation. This is an excerpt from example 17, two-stage FCFE valuation model with declining net income growth in stage one. So this is also possible that you have a high growth rate, very high growth rate, which is declining, and then eventually it stabilizes. Now, I actually included this excerpt because I wanted to connect this with what we have seen before. You can read all the text given in the example, but notice these numbers. We are given fixed capital investment per share. These numbers are actually given as part of the question. And then also the working capital is given as part of the question. You are told, in fact, that the working capital investment every period is half of the fixed capital investment. The fixed capital numbers are given, and then the working capital, you are told, is half of fixed capital. So the slightly tricky item here is to compute the debt financing. So what is the net borrowing every period? And how do we do this? To come up with net borrowing, we need a debt ratio, and we are given that the debt ratio is 30%. This is also given in the question. So if the debt ratio is 30%, then what's your net borrowing on a per share basis? So in any particular year, you add up the fixed capital investment and the working capital investment and take 30% of that, and the 30% number essentially will be the debt financing. So the rest of this is fairly self-evident. If you have FCFF numbers, you can then use the debt financing or the net borrowing to come up with FCFE. Example 18 talks about two-stage FCFE valuation with declining sales growth rates. All these are fairly straightforward, just different ways of doing essentially the same thing. If you have time, you can go through that example. And then 3-stage growth models. This should also look very familiar. 3-stage models are a straightforward extension of the 2-stage models. One common version of a 3-stage model is to assume a constant growth rate in each of the 3 stages. You've seen this before. The growth rates could be for sales, profits, and investments in fixed and working capital. External financing could be a function of the level of sales or changes in sales. We've seen this before. And the simplest form of this model would be where we directly assume the growth rate to be associated with FCFF or FCFE. I hope you see the point here. One complicated way of doing this is to assume that the sales will grow at a certain rate and then use ratios and so on to come up with the bottom line impact on FCFE. A simplistic approach is to directly assume that FCFE or FCFF will grow at a certain rate. A second common model is a 3-stage model with constant growth rates in stages 1 and 3 and a declining growth rate in stage 2. Now, in this particular reading, the relevant examples actually give you the exact declining growth rate. So if you look at the growth rate over time formula, you have a constant rate and then you are given some declining growth rates and then a constant rate again for the 3rd stage. This reading doesn't explicitly talk about the H model, but can you imagine an exam question where you have to apply the H model with FCFF? It can easily show up because the calculation is exactly the same. You could have a scenario like this where instead of talking about dividends, we are talking about free cash flow to firm. So you would use the H model to come up with the valuation at this point and use the exact same logic that we did earlier with the DDM related numbers. All right, this is another straightforward example which is based on 3-stage FCFF, and I'm not going to run through this because it is quite easy. All this material you have seen before. Just at a high level, what we are doing is we are given the growth rates, and as I just mentioned, in this 3-stage model, we have a constant rate of 8.8% initially, and then we decline, and then there is again a steady growth rate after a given period. And essentially, we are discounting the FCFFs back. There is a terminal value at the end of year 7 based on all these numbers, and that terminal value is based on Gordon growth model. You get the terminal value discounted back and add the present value of all the other cash flows. Hopefully this is extremely simple. If it is not, then I would be somewhat concerned. All right, so that's the answer you would come up with. Okay, the final section of this reading, which is a very short section, non-operating assets and firm value. This actually is important because I find several students who get confused by what is stated over here. It is a fairly basic concept though. Let me read what the curriculum says and then I will explain it. Free cash flow valuation focuses on the value of assets that generate or are needed to generate operating cash flows. If a company has significant non-operating assets such as excess cash, excess marketable securities, or land held for investment, then analysts often calculate the value of the firm as the value of its operating assets plus the value of its non-operating assets. In other words, the value of the overall firm is equal to the value of the operating assets plus value of non-operating assets. So what does this mean? When a company has property, plant, equipment, and so on, and cash flow is being generated, who has a claim against that property, plant, and equipment and the cash flow that is resulting? It is all suppliers of capital. So if this is the set of operating assets and cash flow is being generated, then when we come up with the present value of the cash flow, that essentially is the value of our operating assets. Now, if in addition to these operating assets, let's say that this present value is 100 million. In addition, a company has 20 million in marketable securities that have nothing to do with the operations. Doesn't this 20 million also add to the value of the firm? It does, because it is in the firm's bank account, let's say. Therefore, the total value of the firm in this scenario is 120 million. Now, let's also say that the market value of debt is 30 million. Then what is the value of equity? The value of equity would then be the total value of the firm minus the market value of debt, which is 90 million. And this connects with one of the first points I made in this lecture, where I said that I'm just brushing over the point for now, because throughout most of this reading, we have assumed that the value of non-operating assets is essentially zero. For most companies, the non-operating assets would be a very small percentage of operating assets. So very often this number is ignored. Another source of confusion is that in some of the formulas in this reading, you will see that value of firm is equal to the present value of all the free cash flow to firm. And here we see value of firm is this plus this. Why is that? When we say value of firm is present value of free cash flow, essentially we are then assuming that this is close to zero. So I know I'm repeating here, but if that assumption is not true, then you need to add the value of non-operating assets to come up with the overall value of the firm. All right, let us now summarize the main points. Free cash flow models relative to dividend discount models. One of the most basic points here is that you need to understand when to use the free cash flow model relative to the DDM. You can use the DDM when a company pays dividends and dividends have a clear relationship with the profitability of the firm. If not, then you should not use the DDM, then you use free cash flow models. The next question then becomes when to use FCFF versus FCFE. If a company is highly leveraged and there are situations where FCFE are negative, then it makes sense to use FCFF. Another situation is where the capital structure is fairly dynamic. There again, it makes sense to use FCFF. What is the link between the value of a firm and value of equity? So you can come up with the value of the firm by taking all the free cash flow to firm. So all those free cash flows and discount back using WACC. That will give you the value of the firm. Again, assuming that the non-operating assets are negligible. And then from the value of the firm, how do you come up with the value of equity? You simply subtract the market value of debt. If you are discounting FCFE, then the discount rate you use is the cost of equity, and the present value that you will get will be the value of equity alone. Here I have actually listed all the FCFF formulas that we have talked about in this reading, and I am listing them here because I think it is extremely important for you to learn these, and you need to do that. Either you learn them or you learn how to derive them very quickly on the exam, because you are bound to see this. Two-stage and three-stage models, I'll not talk much about them over here, because this is material that you've been seeing over and over. So once you have a pattern for your free cash flows, then based on that pattern, you can come up with the present value. You might have the most simple scenario is a one-stage where you use Gordon growth. In a two-stage, you will make a certain free cash flow for a few years where you discount back individually. And after that, you assume either Gordon growth or you use a multiple to come up with the terminal value. And then you can also have three-stage models. You can have the H model and so on. All right. So that brings us to the end of this reading. As always, go over the summary, review the learning objectives. I have covered most of the examples. Make sure that the examples I have emphasized in this reading are examples that you carefully go over. The examples that I have not emphasized, if you have time, then read them. You must do the practice problems, and also, if you have time, do practice questions from other sources. One concluding remark is that, in my opinion, this is the most important reading in the level 2 curriculum. And the reason I say that is, clearly, in terms of weightage, equity is most important. It has the highest weight. And if you speak to equity analysts, obviously they use multiple models, but the model that is used most frequently is a free cash flow model. So I would say that the probability of a case study showing up which is based on this reading is extremely high. So obviously you need to study everything, but make sure you have a good grasp on this material. That is it.